Are we ready for Dreamforce? Yeah! Woo! So we're going to have a panel of VCs here, but just kind of following up from our last conversation, how many of you guys are actually from the outside versus the inside? How long have you been in insurance? Let's say those who've been in insurance for more than 5 years, raise your hands. Wow, got quite a few insiders, right? Interesting. So it's related to this panel because obviously you're in the business of finding those outsiders that you could invest in who could disrupt the industry. Making the connection here. I'd like to start by going around, brief introductions, your investment philosophy. Let's start with you, Josh.
Sure. My name is Josh Nussbaum. I'm a principal at Metamorphic Ventures. We're an early stage venture firm based in New York City, but we invest all over the country, a lot in the Bay Area actually. And the thesis is companies that disrupt or enable traditional industries. So we spend a lot of time looking at those industries, things like insurance, but other financial services, healthcare, CPG, retail, automotive, kind of you name it, looking at sort of what the opportunities are within them. Is the play to build a marketplace? Is it an aggregator? Is it a SaaS platform? Depending on the inefficiencies. And so we invest in roughly 12 companies a year, about one a month on average. And we've made a couple of insurance investments to date and are pretty active in that space more recently.
TX.
Hi, my name is TX Zhuo. I'm one of the partners at Fika Ventures. It's a new fund that we started a couple months back. Previously, I was the managing partner at Karlin Ventures. I've done a lot in the Fintech space, investors in SoFi, Policy Genius, Gift, to name a few.
That was efficient. Arjan Schutte. I'm a managing partner at Core Innovation Capital. We are a financial technology fund primarily. We're essentially investing in companies that are fairly early stage and that we think have mass market approach. We're investing in better solutions for everyday Americans. We're Series A focused. We'll do growth stuff, occasionally write smaller checks. And as a function of being deep in the financial services industry, we have gotten excited about what's happening in the insurance space in the last couple of years.
Excellent. Chad.
My name is Chad Nitschke. I'm a general partner with Insure VC. So we're a little bit unique. We're an angel fund that's focused exclusively on insurance. So a little bit unique in that regard. All of my partners and myself come from the industry. We formed about a year and a half ago. We focus predominantly on seed stage, so really early, pre-seed, seed stage. And then I'm also, in addition to that, a co-founder and CEO of my own InsurTech startup called Bunker.
Bunker, all right, nice. So could you call out a few examples of portfolio companies whom you think are really making waves in the industry? Let's start with you, Josh.
Sure. So we're investors in a company called BetterView, which is a marketplace for drone operators and insurance companies. And what they do, the first vertical is for inspections, roofing inspections. And so they integrate with a number of carriers, and when the carriers need to get photos of a roof, they will use BetterView solution. They'll send a drone out to take those images, and they'll do all the data analysis and send them the reports back to the insurance companies. And then we're investors in a company on the benefit side called eCentral, which is like Zenefits, but they sell directly to the broker. So given the changes in the ACA, small businesses, employees need to be able to interact with their health insurance in ways that they couldn't before. That provided an opportunity for a SaaS solution to be built. And then we're also investors in a company that we haven't announced yet more recently that sells software to SMB commercial brokers.
TX, any companies that you want to talk about?
Sure. I think we invested in the insurance space back in the early days with these guys where I think it wasn't as sexy or exciting as it is now. So when we invested in Policy Genius, I think we led the seed/Series A round. I think a lot of you saw Jen speak this morning. So very excited about the life insurance space, like a lot of other categories. It's just a space ripe for disruption. I'll give you a couple of interesting stats. The average life insurance agent is 59 years old. none of these big carriers actually have an online strategy to deal with millennials. That has changed obviously over time, but that was back in the day. And the third is that the average policy for life insurance, it's close to 10 years. So if you think about the commissions and premiums that these carriers get, it's amazing. So when we looked at the landscape, I think we saw this as a super exciting opportunity that we wanted to place a bet on. So that's how we got involved.
I like how back in the days, 36 months ago, spoken as a true VC.
That's a seed stage investor. Everything works in 36 months. No, kidding.
So I'll give a totally different example. We've invested in a company called CoverHound. CoverHound is in the P&C space, mostly doing online. It's an online marketplace, and they allow carriers to bind policies for consumers for auto, homeowners, and renters insurance. And we're a really early pioneer to make it possible for a long tail of very small carriers, in addition to some bigger ones, to be able to even do a whole online multi-stage underwriting and binding process. Most of them don't have the tech stack to do that, and they really provide a lot of back office capabilities to bring them into the internet age.
Got it. Chad.
Sure. I'll give two quick examples. So one of the companies that we recently invested in is Pillar Technologies. They're an IoT startup. They're actually in the Techstars IoT accelerator right now. But essentially what they're focused on is solving the problem for construction companies around a site damage. So basically like an IoT sensor-based risk management platform for construction companies. Really great founders, 3 electrical engineers, super smart. They dove deep into the space, deep into the problem. Almost by accident, they developed a helmet that was used to detect concussions. And they tried to sell that to the NFL. Not surprisingly, the NFL said we don't want to, draw a lot of attention to concussions.
Too late.
Yeah, exactly. And then they went to construction companies with it, and construction companies said, "Hey, this is cool, but we've got all these other problems. If you can help us solve that, we would love to partner with you on that." And so really strong signals kind of early on with that. And the other company we recently invested in is a company called Patch. And what Patch is focused on is, and all of you, I would imagine, can relate to this. So they are focused on the out-of-network reimbursement problem. So in other words, if you have an out-of-network health claim, we've all had that. It's a pain, right? You have to file the claim manually, and they're focused on streamlining that process and really giving, if you think of all those medical benefit providers, like LensCrafters or Costco that fall outside of the network, that's a hurdle for them, and so they're streamlining the process for those organizations, which creates a nice incentive for them, but then also for the consumer, it just makes it a more seamless process. And we like the macro trend on that too, just as we think more healthcare coverage is going to move to out of network, and we're already starting to see that happen.
So we're beginning to revisit some of the themes that we've heard earlier in the earlier panels, right? Chad, you're talking about efficiency. Around Policy Genius, we're talking about the customer experience. Transparency is another theme. What is it about insurance for you that makes it such an interesting space to invest in, and why now? Anyone can jump in.
Sure, I can start. I think for us, there are sort of a lot of inefficiencies in insurance, and kind of all across technology startups, you see the sort of trend of disintermediation, transparency, better customer service, a lot of that being spearheaded by Amazon. But you look at insurance, and it's steady stream of recurring revenue, big industry, but there is sort of this known outcome to it where you sort of know whether or not the policy is good at some point in the future, but then there's all these variables used for underwriting, and that's actually what machine learning technology is really good at, is taking variables, and so all the data that's being collected now can be processed and stored. And so I think that's why a lot of VCs are interested in a lot of the direct insurance companies, and that also creates momentum on the other end for the larger companies to buy technology, partner with startups as well. And so you sort of have that change from a technology standpoint, and then changing consumer expectations across the spectrum, which are multiple things that VCs have taken into account in other industries, but it kind of all comes together in insurance, and it happens to be a very, very large market as well.
TX.
I think for me, we'll always see innovation in insurance. It's one of the largest categories if you think about industries and that represent our economy. I think we have over $1 trillion in premiums written every year. It forms about 7% of GDP. So for me, as a category, it's always going to be interesting because there's always going to be pockets of innovation. I think the thing that it's more surprising is that all insurance products were created for people who use pen and paper as their main form of communication, which is crazy, right? In today's day and age, if you look at every single form of communication, that's how it's done. So I think sort of there's a huge gap or divide between the digital age and where insurance is. So for me, I think that brings a huge opportunity for technology to actually help bridge this gap.
Right. Arjan?
Well, I'm not going to be that original, but basically, giant market riddled with inefficiencies. That's clearly a recipe for something interesting. And then I think one of the things that we look for a lot is there's some structural issues, and I perceive that there's a lot of people who are either underinsured or overinsured, and a lot of that is a function of what I perceive as principal agent risk, which comes out of some of this pen and paper predominance, that you've got people selling insurance.
Yep.
Those people often put their customers into the wrong policies, and where the U.S. is lagging the rest of the developed world in terms of how insurance is being delivered, and so the ability for the machine to provide better advice to a customer who basically doesn't like thinking, who doesn't know how to think about insurance at all, from the simplest policy of a renter's policy to a life insurance policy or an annuity. This is not something that people like to think about at all. To us, it's very similar to what we see in financial services. People don't like planning. It's difficult to plan for. It's difficult to anticipate negative outcomes. And so for a machine to be able to take a lot of data and provide someone better advice as to what kind of policy is fit right for them without an incentive to put someone into too much or too little policy is both a great opportunity and I think just a net positive to society.
You brought up a really good point around the principal agent risk, and that's precisely the reason why the Department of Labor has increased the fiduciary requirements, at least the burden of proving that you're looking out for the customer's best interest. Do you see that regulation leading to the accelerated adoption of the robo-advisor and more automated forms of advice?
You mean in asset management or in insurance?
In insurance or life and annuities, retirement, sure, and even asset management.
Yeah, I think it has to. I think it's a really powerful catalyst.
Sure.
I think it's a useful and, in my mind, a totally appropriate place for regulators to weigh in and make sure that people are aligned with their customers. And there's notably absent in financial services and in insurance a notion of a Hippocratic oath that exists in other disciplines, like in medicine. And so why shouldn't there be such an idea?
Right.
So yeah, I think
Right.
so.
Chad, what makes insurance such an interesting place to invest for you?
Yeah, so I'll try to offer a unique perspective since I came from the industry. So I'm kind of one of these weird people that over the past 15 years, I think I woke up every day wanting the insurance industry to be better. And now I think we're at a point where capital is moving in, like you're starting to get kind of the wheels are in motion to make the industry better. And so for me, I think that's incredibly exciting, right? There's capital getting behind some of these projects and some of these startups. And I think one element that I'll mention that wasn't previously mentioned is just that the insurance industry historically, one of the ways that they solve problems is through acquisition, right? So, a lot of insurance companies maybe they're not as effective at executing maybe on new technology or innovation, but they're really good at acquiring, and they have a lot of capital to do so. And I think that element of being a startup investor, lends itself to being attractive.
Excellent. So what are some of the common barriers of adoption for some of your startups, hitting that hockey stick? And how are they overcoming those barriers?
Just to get out of our usual order.
Thank you. Thank you. Let's break it
and
up.
we should be interrupting each other, right? The
Yeah.
panel is never
It's
quite
an
alive.
insurance panel. You have to follow the process.
Okay, you first. I mean, the obstacles are many, and there's probably more arguments why this is a terrible vertical for venture capitalists to invest in. You can't. There's no quick iteration cycles. It takes a long time to see the results of any changes that you implement. It's incredibly capital intensive. It's regulated in all 50 states. There's no federal regulator. The incumbents are massive, and their disincentive from cannibalizing their own business is significant, despite all of the insurance carriers offering their own venture initiatives, which we can talk about if that's on the agenda as well.
Mm-hmm.
But I think there's really very many good reasons to not be investing in this space.
Wow. What are
so-
some of your thoughts, Josh or TX?
I think for me, I think one of the common barriers is are you a friend or are you an enemy, right? For the carriers, because a lot of them look at innovation in two ways. Are these guys going to eat my lunch, or are these guys going to be complementary? So I think the best businesses we've seen, we invested in a company called Remedy. That's actually a pretty cool concept. Take a picture of your medical bills, whatever they can save you, because medical overbilling is a huge problem. You keep 80%, they keep 20% of it back. And to the insurance carriers, this is great, right? It lowers the out-of-pocket payment that a lot of them have to make. So at least when the incentives are aligned, all the carriers are more than happy to work with you. But we've seen cases where it's been tough, not in our portfolio, but companies we looked at, where they run into very strong headwinds when the incentives aren't aligned. So I think that's one common barrier to entry that we see.
Sure.
Yeah, I think we haven't invested in any sort of direct models to date, but in the B2B side, you see a lot of companies that have people who don't like interacting with technology. They don't directly benefit from it in the short term, and so you sell top down, and getting sort of the rest of the company on board to using the new technology is really difficult unless they're incentivized as part of the sale. And the other thing I think we've seen in financial services away from insurance is sort of the rise of APIs that allow developers to come on and build products and services, whether it's Stripe and Braintree or a company like Plaid, and you haven't really seen that in insurance, which makes it much harder than for startups to come in and build products from day one, because there's no easy way to sort of outsource some of the challenge that they face.
You guys were nodding when he mentioned the rise of APIs. Did you want to chime in?
Yeah, I would definitely echo that comment. And we're still really, really early in kind of this insurance cycle, and technology scales really well. Insurance doesn't scale as well, and so I think it's just going to take some time for insurance to catch up and to be able to scale. It varies kind of with the product, but just in general, I think.
Yeah.
Yeah, so to also echo the truth of that, I don't think fintech became fintech. In the popular mind, fintech became fintech after two IPOs, Lending Club and On Deck. But I think to a lot of the industry under the hood, it was really a number of APIs that became available, starting with the old guards at Yodlee, and then newer versions of that like Plaid, which really democratized the access to our very basic banking information to a bunch of people developing stuff. And I think that kind of access through APIs, as well as the Stripes and Braintrees, really was transformative to making it possible for lots of people at fairly low cost to really reimagine what a whole slew of financial services would look like, and we are still waiting on that in the insurance space. And I think that that'll similarly be a tipping point where we really start seeing a much greater amount of blossoming of entrepreneurial energy in the insurance space.
Got it. Do we have any questions from the audience? Any questions online? Oh, Faye, go for it. Sorry, you're going to need a microphone. Sorry about that.
What are you most excited about what's coming up and the ventures happening? And how do you think of yourselves between your venture, independent networks, and corporate ventures like the ones we mentioned?
So the question was about what's getting you excited in the venture space, particularly with partnering. Was it partnering with venture CVCs, corporate VCs?
So I think for me, we've been very excited about episodic insurance policies. So we've seen it play out a bit in Asia, but not quite in the US. And sort of, I think what could be very interesting from the corporate side is obviously to offer us the data where we can actually underwrite and understand the risk involved in these policies. So I think on the corporate side, I think the value add is that you have this huge database of users, you have this huge database of events that have happened, and to use this data to actually support startups, that could be very interesting. So that's a space we would be very interested in partnering with one of you guys.
Yeah, our thesis in lending was always sort of proprietary origination and/or proprietary underwriting, and I think that's what gets us excited too in the insurance space, especially when it comes to products and services that may produce data that allows a startup to underwrite better and faster than somebody else coming into a new space, whether they're a large carrier with a big balance sheet or not, especially as it relates to new products that are already connected to the internet and produce these micro segments and new sort of insurance products as well. And on the corporate side, I think we've invested with corporate VCs. I don't know about in the insurance space, but in other categories, they tend to be a good source of capital. It's good to have sort of the access to industry to be able to ask questions for the founder and understand certain things, especially if they don't come from that. The difficult thing for us is that the incentives aren't quite the same for the company as they are for the founders and the team and the VCs as well, because initiatives change at big companies, people change, leadership, et cetera. And so for those reasons, I don't know that we'd want to be just the only investor with a corporate VC arm, especially if it's not sort of separate from the actual company. But if there's another VC in the mix, I think that'd be something we're excited about, or further on in the company's life cycle as well.
Arjan and Chad, any thoughts?
Yeah, just on the topic of what's interesting. So I think one thing that we haven't invested in this yet, but we're kind of intrigued by it, is parametric insurance. So in other words, one point of friction is the claims process, right? I mean, the claims tend to be pretty subjective for some lines. So I think if you can make that more of a binary transaction and say if X happens, then you receive Y, that's intriguing, and I think it removes some of that friction from the claim process. And it's also a fairly simple solution. Like we really like simple solutions too, so I think that's attractive. And then from the corporate VC perspective, I mean, I can just offer my insight as more of a founder. So we had both American Family Ventures and then Hiscox participate in our seed round. And I think some of that comes down to the details, right? So from my perspective, the way I looked at it was, I don't want just one on our cap table. Like if we're going to have someone invest, it needs to be more than one, more from just an optics perspective, right? Because you're going to have more insurance partners. And the other part that was fundamental for me, at least, was just around the amount that they were investing. So we wanted to keep that below 5% for each of them. And then also just no board control, no special rights agreement. I mean, that's kind of table stakes, but those were some of the aspects that we kind of looked at when considering, should we have a corporate venture firm invest.
I'm going to be deliberately controversial here while we're on the topic of CVCs. Fred Wilson actually, and I'm going to quote him, said corporate VCs are dumb. What are your thoughts on that? And what do you think corporate VCs are up to?
Well, the sad truth is probably most venture capitalists are dumb too. And if you look at returns for venture capital, it's a power curve, and so you have to be in the top decile or you're losing your LP's money. And so, I mean, I'd say that back. That said, like making your life on making venture investments is a particular undertaking, and I think there's a lot of dynamics that are not that easy to understand, and I think those are not necessarily captive in what most corporate ventures are hiring, and they're all across the board. I mean, I think your kind of framework in terms of having some constraints around how you engage with them makes total sense, and I think we should be seeing more of that. And there's some super smart corporate venture funds in the insurance space that we've interacted with.
Yeah, I think what I would say for corporate VC and know your spots to pick, right? I think a lot of times when you get into the venture investing game, it's a lot about synergies that an investment could bring to your corporate business. So I think if you could get, say, 10 million in synergies, whether it's in a cost improvement, then that's a win, right? You don't really have to make money from your actual investment. So you see it that way, you pick your spots where you're investing in companies that have strategic value, then it'll be a win for everyone. But I think what tends to be the pitfalls that corporate VCs want to cover it all. So you start out being like an insurance-only VC, but then you do all of fintech into areas that you don't even know that well, and that to me is when things go wrong. But if you don't do that, then I think corporate VCs are a great partner to have.
Josh.
Yeah, I think the
Final
only thing I would add, and I think Chad's framework was really smart, and I think it's something that we suggest our founders think about as well. And I don't remember Fred's post or his reasoning behind it, but I think that part of the reasoning, I would say, is oftentimes, VCs go to a lot of events and networking events and happy hours and whatnot, and there's always corporate investors and it's part of the job. But they're always sort of asking for a solution to a problem that the company has, and they'll say, hey, have you seen anything that's doing this, 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 and this? And it's so specific to that company at that point in time.
Yeah.
And we've seen times when early stage companies are kind of pushed down that path by a big company who says, we'll pay you X dollars if you do this, but it's different than their other customers. They may not actually buy it, they may churn away from it pretty quickly, but it can sort of send a startup early on down a path they may not want to go down. That being said, I'm seeing more and more corporate investors that are different than they were in the past, hiring people out of venture or sort of startups in that space, not just sort of taking people from the existing team and investing in startups.
Got it.
And incentivizing them differently as well, which I think has had a really positive change and impact.
Excellent. Thank you very much. Well, this is our last panel, and before we take off, I invite Shane Cassidy from Capgemini to make closing remarks. Hopefully Shane is out there. I want to remind everyone that over there in that section, we have a bunch of demo stations for the Capgemini solution. Please visit the demo stations and see what the Cap solution is all about. Out here, we have whiskey tasting. So now is time for fun. Fun, food, and drinks. So I'd like to invite Shane Cassidy up. Let's give a round of applause to our last panel here. Great job, guys. Thank you.